Do you find yourself wrestling with complex tax regulations and terminology? Are you often confused by terms like applicable federal rate, AFR? Don't worry, you're not alone. In this brief article, we will demystify the concept of the applicable federal rate and explain how it may impact your financial decisions. So what exactly is the applicable federal rate? Well, the AFR refers to the minimum interest rate that should be charged on certain loans and financial transactions to comply with the tax laws of the United States. It is set by the Internal Revenue Service, IRS, and serves as a benchmark for determining the fair market interest rate between related parties. The AFR is designed to prevent individuals or businesses from providing loans at extremely low or no interest rates to avoid paying taxes on potential income. The IRS sets specific rates for 3 different categories: short-term rates, mid-term rates, and long-term rates. Short-term rates cover loans with a repayment term of up to 3 years, while mid-term rates apply to loans with durations between 3 and 9 years. Long-term rates, as the name suggests, are for loans with repayment terms of more than 9 years. These rates are updated by the IRS on a monthly basis, ensuring that they align with current market conditions. Now you may be wondering how the applicable federal rate affects you. Well, the AFR comes into play when you provide a loan to a family member, a business partner, or any other related party. Instead of charging an arbitrarily low or interest-free rate, you must charge at least the minimum rate specified by the IRS. By adhering to the AFR, you avoid potential tax complications and ensure that the interest income from the loan is accurately reported, benefiting both parties involved. It's essential to understand that violating the AFR regulations could lead to adverse tax consequences and can be investigated by the IRS. To make things a little easier, the IRS provides tables with the current AFR rates, taking the guesswork out of the equation. These tables provide the applicable rates for various loan terms, taking into account the duration of the loan and the compounding period. In conclusion, the applicable federal rate is a crucial tax regulation that determines the minimum interest rate that must be charged on certain loans and financial transactions. By complying with the AFR, you ensure fair market value and avoid potential tax complications. So the next time you encounter the term applicable federal rate, you can confidently navigate the intricacies of tax regulations and make informed financial decisions.